Hello, and welcome to another episode of Financial Festivities, hosted by yours truly, Grand Prix. Today is September 26th, 2021, a Sunday. Today, we will be celebrating and discussing the Federal Reserve and how it utilizes monetary policy to combat things like the COVID-19 pandemic we're currently experiencing and how those efforts can impact things like inflation. But before we get into any of that fun stuff, we're going to take a quick look at the market and see how US equities have been performing over the past week. So just a quick reminder again, today is the 26th of September, which means the market closed on last Friday on the 24th. So the Dow closed at 34,798 points, putting it up nearly 1% on the week. For those of you who cannot see, I'm wearing my Dow 30K hat, which celebrates when the Dow Jones Industrial Average, one of the most followed stock indices for American equities, broke 30,000 points for the first time. I believe it happened last year in November of 2020. Very exciting day. I remember it for a very long time. Along with the Dow, the NASDAQ composite also did very well. It closed at 15,047.7 points, putting it up nearly 2% on the week. So tech did just great. And then the S&P 500 also did just fine, closed at 4,455.48 points, putting it up over 1% on the week. So the market had a nice week. Part of the reason was the market had a positive reaction to the September Federal Reserve Board meeting, which concluded last Wednesday. It was a two-day meeting. It went through Tuesday and Wednesday. The Federal Reserve meets 8 times a year, and they put out projections on the economy once a quarter. So basically every other Federal Reserve Board meeting. September was one of the meetings where projections came out. So it was interesting to see what board members had to say. And we're going to talk about some of those projections later in the episode. Before we get into the topic of the day, I have to again disclaim that I'm not a financial expert. What I'm saying is most certainly not financial advice. It's just my opinions. I don't think that disclaimer will be, as applicable on this episode because I'm not really delving into investments or talking about specific stocks. We're just kind of doing an informational talk about, the economy and how the Federal Reserve operates. So, what is the Federal Reserve? Well, the Federal Reserve is essentially the central bank of the United States of America. There are 12 regional Fed banks across the country, one of which is located in Chicago, which I think is very cool. Along with the 12 regional banks, there's also the main bank headquartered in DC. That's headed by the chairman of the Federal Reserve and the board. The chairman is currently Jerome Powell. All right, so now you know what the Federal Reserve is. What is its job? What is its responsibility? Well, the Federal Reserve has 2 main jobs. The first of which is to promote maximum employment. That basically means the Fed wants to make sure unemployment is as low as possible, but is still at a sustainable rate. As weird as it might sound, unemployment can get too low. You kind of want at least some level of employment or unemployment. And also, the Federal Reserve wants to make sure prices stay stable. Basically, the Fed aims for an annual rate of 2% inflation. For those of you who don't know what inflation is the term that kind of captures the concept of the purchasing power of a certain currency decreasing over time. In our case, it's the US dollar. So, for example, we all know how things in the past were way cheaper than they are now. I know a long, long time ago, you used to be able to buy a bottle of Coca-Cola for a nickel. And now whenever you go to a vending machine, it's at least $1 or $1.50, if not more. So that kind of shows in our personal lives how the value of our currencies decreased over time, therefore making it more expensive to buy the same thing of value. Inflation is a rather important concept. It's something we're going to be talking about a little more throughout the episode. There are 2 main metrics that people use to measure inflation. One of which is the Consumer Price Index, abbreviated as CPI, and the other one is called the Personal Consumer Expenditure Price Index, or PCE. They're fairly similar. There's a couple differences. The PCE is calculated by the Bureau of Economic Analysis, which is part of the Department of Commerce, And that's the measurement that the Federal Reserve uses to make their economic projections and make decisions on monetary policy. So that's probably PCE is the metric we'll be talking about throughout the whole episode. And then CPI, which is also, a widely used metric, is calculated by the Bureau of Labor Statistics. One main difference between the two, CPI tends to show higher rates of inflation than PC, but they're similar. Both metrics work just fine. You don't really need to understand the inner workings of how the metrics are calculated. It's actually quite complicated. All you need to know is that essentially to find the value of inflation, they just track thousands of goods and see how their price changes over time, through surveys, seeing, if food, gas prices, energy prices change. So that's really all you need to know about inflation metrics. PCE and CPI are the two main ones. As I mentioned last episode, I kind of try to include a quote that captures my investment philosophy. This one doesn't, but I thought it was too funny to not tell you guys it. I think the best part about this quote is it's not even from like an economist or anything like that. It's from a man by the name of Sam Ewing, who was a professional baseball player. I believe he used to play for the Chicago White Sox, which is cool. So, go White Sox. So he said inflation is when you pay $15 for the $10 haircut you used to get for $5 when you still had hair. So I just thought that was a funny and straightforward way of explaining inflation and how it impacts us in our daily lives. So I thought you guys might get a kick out of that. All right. So we've covered that the Federal Reserve wants employment up and inflation, relatively low. It wants slow growth of inflation, 2% a year annually. But how does it go about doing this? The Fed tries to accomplish these goals through monetary policy. Monetary policy might sound similar to the term fiscal policy. The reason they differ is fiscal policy that's directed by Congress. The House of Representatives and the Senate, deals with spending bills and the federal budget. So, for example, during COVID, when many Americans received stimulus checks, that was for spending bills that was passed in Congress. So that's fiscal policy. When you hear fiscal policy, think federal budget. But monetary policy is separate. It's dictated by the Federal Reserve. And the Federal Reserve basically has three tools they can use to direct and implement monetary policy. The first of which is the discount rate, or manipulating the discount rate. The discount rate essentially is the interest rate at which commercial banks can lend overnight from the Federal Reserve. So if a commercial bank needs to meet a reserve requirement or needs excess funds, they can loan just from the Fed overnight. And the discount rate is the rate at which they have to pay interest on that loan. The second tool is the reserve requirement, which I just mentioned. Essentially, the reserve requirement is the percentage of deposits that banks need to hold with them and not lend out to people. The way banks make a lot of their money is they take in deposits from customers who want to save their money, and they loan out the majority of those deposits and earn interest on those loans. So the reserve requirement says, okay, you can loan out the majority of your deposits, but you have to keep some in case some customers want to withdraw their funds. So an example, let's say that reserve requirement is 10%, which is rather standard, and a bank has received $500,000 worth of deposits. If the reserve requirement is 10%, that means the bank needs to hold 50K of the deposits in case people want to take out their deposits, and then can loan out the rest of the 450K. And then finally, the third and final most important tool would be open market operations, which is just a fancy word for the buying and selling of U.S. Treasury bonds and or mortgage-backed securities from banks. Now, why would the Federal Reserve want to purchase U.S. Treasury bonds? Or purchase or sell. Essentially, what this allows them to do is change the money supply in the economy, which can directly or indirectly affect consumer spending. So like right now, for example, the Federal Reserve is currently purchasing bonds from banks. And what this allows them to do is when the Fed takes in the bonds, they're essentially crediting the banks with money. And what that allows them to do is, loan out more money. make more loans and essentially try to increase consumer spending, which can help start stimulating the economy, especially during times of recession. And then in contrast, this doesn't happen as often. But the U.S. Treasury, or sorry, the Federal Reserve can also sell U.S. Treasury bonds to banks. And what that does is essentially takes money away from banks to the Federal Reserve, which limits the money supply in the economy, allowing for banks to not be able to lend out as much, kind of decreasing consumer spending, which could tame an overheated American economy. The open buying and selling of bonds can also impact the effective federal funds rate. The federal funds rate is the rate at which commercial banks lend to each other. Again, the discount rate is the rate at which commercial banks lend from the Federal Reserve, but the federal funds rate is the rate at which banks lend to each other. The Federal Reserve does not directly control the federal funds rate, but they try to target it through open market operations, like we said, or the buying and selling of bonds. So just a quick kind of timeline of what the Federal Reserve has done to combat this COVID-19 crisis through monetary policy. A lot of it happened in March, at the beginning of March in 2020. On the March 3rd of 2020, the Federal Reserve cut the federal funds rate target down to a range of 1 to 1.25% from 1.5 to 1.75%, or a 0.5% decrease. And then just a week and a half later, they cut the federal funds rate target down from 1.25 to 1% to 0% to 0.25%. So a whole percent decrease. So essentially that made the federal funds rate target 0%, or the target at least. And then also on the March 15th, the Federal Reserve cut the discount rate down to 0.25% from 1.5%. So a decrease of 125 basis points, which is quite severe. And then also on the 15th of March of 2020, the Federal Reserve also dropped the reserve requirement down to 0, which means it's still at 0, which means the banks can lend out all their deposits in hopes of stimulating the economy. So that basically means the banks don't have to hold any money. They can loan out as much as they deem fit. And then also on the 15th, the Fed announced that they begin buying 500 billion in bonds and 200 billion in mortgage-backed securities a month over the coming months. So $700 billion in bond purchasing overall, which is a lot. And then on March 23rd of 2020, the Fed expanded that even more, announcing they wouldn't put any cap on bond purchasing, essentially allowing for unlimited purchasing of bonds as they seem fit with the ever-changing circumstances of the economy. April through May, they kind of tamed things a little bit. They tapered back their bond purchases. So they stopped buying bonds from April to May, but in June they picked it up again. They ended the tapering and began buying 80 billion in bonds and 40 billion in mortgage-backed securities for a total of 120 billion in purchasing a month. That's obviously a decrease from 700 billion a month, which they were doing in March, but it's still quite a lot. And that 80 billion in bonds and 40 billion in mortgage-backed securities is still a policy they are doing to this day. So as of right now, that's how much the Fed is buying of bonds and mortgage-backed securities a month. So now we can talk about kind of what occurred at the September meeting last Wednesday. So the main topic, or what people were discussing, was whether or not the Federal Reserve would announce the tapering of bond purchasing, because at some point the Fed has to stop buying bonds, because as the economy increases, there's no point of needlessly increasing the money supply. So many people thought that September would be the meeting that they said, okay, we're gonna begin tapering at some point. However, that wasn't the case. After the meeting, there was no announcement of any tapering as of yet. Here's a quote from the press conference. After every single Federal Reserve meeting or board meeting, the chairman has a press conference. So here's what Powell had to say on the tapering of bond purchases from the September meeting. He said, quote, If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. Although decisions were made, participants generally view that as long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate. So again, no necessarily claims about when the tapering will begin, but like we were kind of given a timeline of at what point the tapering will end, which is somewhere in the middle of 2022. So like we mentioned earlier, the Fed looks just on average for the inflation rate to be roughly 2% each year. However, with COVID, due to the recession, there was a ton of deflation because people weren't buying stuff. So because of that, the Fed kind of, in layman's terms, the Fed kind of wants to play catch up with inflation. So they don't want to just see 2% inflation right now. They almost want to see higher than 2% inflation. They refer to it as transitory inflation. So they want to see higher rates because then that will over time average to a 2% rate of inflation. But those high rates of inflation have been achieved if we look at the data. So PCE, again, as we talked, is the inflation metric that the Fed looks at. So in February, the PCE was only 1.6%, which means inflation had only gone up since a year ago in February, which is of course below 2%. But in July, which was the most recent data I could find from PCE metrics, inflation was at 4.2% since 12 months ago in July. So 4.2% is way above where they'd like to be in terms of inflation. So I think that the inflation goal is met. So I personally think tapering of bond purchasing might soon, be warranted as well. And then if you look at the unemployment rate was up at 6.2% in February, but right now it's in August, it's down to five, or not right now in August, but in August, it's down to 5.2%. So we're making strides in both inflation and employment. Although nothing's official, a CNBC survey of members of the Fed expect for there to be an announcement of tapering at the November meeting, and the tapering process actually beginning in December. So if that's the case, tapering will begin before the end of the year. Some interesting things from the September meeting, besides talking about tapering, is the projections from board members of rate hikes. So of the 18 voting members of the board, a surprising amount of people voted for rate hikes in 2022. So if I just pull up the data really quick, if you look at the dot plot chart, which is a graph lots of people look at for the projections. So for 2021, none of the 18 board members of the Federal Reserve see any rate hikes. And when I say rate hikes, that's referring to increasing the discount rate, but really mainly increasing the target rate for the federal funds rate. So none of the 18 members see any rate hikes in 2021 as expected. But in 2022, 9 board members, which is half of the voting members, see a rate hike in 2022, and 3 even see 2 rate hikes. And then, of course, in 2023, all but one member sees at least one rate hike, with also majority of members seeing multiple rate hikes. So that was perhaps the most interesting thing that came out of the September meeting, was just seeing the timeline of rate hikes. So most likely we'll see increasing in the rates in the middle or before the end of 2022. So that was really the main thing from the September meeting. So we've talked about what the Fed has done, everything in the timeline, but you guys might be thinking, okay, why does this matter or affect me at all? Well, I can understand that some of this might just seem just like a lot of technical talk that might not really impact people on a personal level. I disagree. I think some of this is actually extremely important to, individuals, even students, especially students actually in some regards. Inflation obviously impacts everybody. If the Federal Reserve does not properly manage inflation, prices will run rampant and, things from gas to food will become extremely expensive, which obviously takes a toll on the American economy. Um, but I also think the most important thing probably would just be staying in the loop with interest rates. We've talked about the discount rate and the federal funds rate, which the Federal Reserve either directly or indirectly controls. Every other interest rate in America closely is affected by those rates. So student loans is a big thing with people our age. As we're going to college, the majority of us aren't going to be able to just pay for college out of pocket. So we're going to have to take out loans from the government or yes, from, banks. So when eventually the Federal Reserve does increase rates again, that will mean it will essentially be more expensive to go to college. So right now, with rates as low as they are, that's why a lot of people are taking advantage, with refinancing their homes. They get a lower interest rate on that, things of that extent. So I just think in general, it's important to have a general awareness of where interest rates are and where they might be heading in case you have any, big economic or big financial decisions in your life, like purchasing a car, a home, or, applying for student loans, because, knowing when those rates are going to change might impact, when you want to, make that decision and take that loan out. So that's all I have for you guys today on this episode. It'll be interesting to see, how the Federal Reserve moves forward and if tapering will actually occur on the November, introduction, December, execution timeline. We'll see if that plays out. But yeah, thank you guys for watching. And that's all for today.